It is Monday, February 16th, 2026. The banks are open, the wires are moving, and the truth is coming out. I'm scrolling through Twitter this morning, and it's the same thing every Monday. Some dickhead is posting a screenshot of their Stripe dashboard. 100,000 a month, look at me! And everyone claps. Everyone likes the tweet. Everyone thinks he made it. But here is what he isn't showing you. He isn't showing you the $80,000 in ad spent. He isn't showing you the $15,000 in refunds. He isn't showing you the $10,000 in software costs. That is clown math. Today on the Short Game Podcast, we are done with the vanity metrics. We are reading the book that separates the operators from the amateurs, Financial Intelligence. We are going to learn the scariest sentence in business. Profit is an opinion. Cash is a fact. I'm Drew Meitner. I run NexYear. We sell access. We have inventory. We have shipping. If I run out of cash, I don't just have a bad chart. I die. So today, we stop looking at the scoreboard and start looking at the bank account. Let's get into the numbers. All right, listen up. Today, we are going to war against vanity. We are going to war against the clowns who think a sales graph going up and to the right means they're winning. I'm holding a book in my hand. It's called Financial Intelligence by Karen Berman and Joe Knight. Now, look, I know what you're thinking. Drew, you're an operator. You build things. You run NexYear. Why are you reading an accounting book? Because this isn't an accounting book. This is a weapon. This is a lie detector test. Most of you, and I say this with love, but also because I hate incompetence, are financially illiterate. You think accounting is math. You think 2 + 2 = 4. You think if the spreadsheet says you made a profit, you have money. And that is why 90% of you are going to die in the valley of death. Today, we are breaking down the difference between the tycoon and the clown. The tycoon understands that accounting is biased. The clown thinks the numbers are real. The tycoon celebrates the deposit. The clown celebrates the contract. We are going to learn how to read the numbers so you don't end up as another successful entrepreneur who can't make payroll on Friday. Here is the truth, straight from the source material. Berman and Knight lay it out on page 1. Accounting is not math. It is an art. And it is biased. Let that sink in. You think finance is black and white? Wrong. It's gray. It's an opinion. When that guru posts his revenue, he's showing you the top line. Revenue is vanity. Revenue is a promise. It is not cash. You can have $1 million in revenue and be losing $200,000 a year. You can have $10 million in revenue and be bankrupt next Tuesday. The book talks about a concept called the matching principle. It sounds boring. It's actually dangerous if you don't get it. It means accountants try to match costs to revenues, but they make estimates to do it. They make assumptions. Here's a story from the book. Back in the day, a company called Sunbeam had a CEO named Chainsaw Al Dunlap. This guy was a legend. He slashed costs, fired people, and the stock price skyrocketed. But he needed to show revenue growth to sell the company. So what did he do? He used a trick called bill and hold. He went to retailers like Walmart and said, "Hey, buy these gas grills now, in the middle of winter. We'll bill you, but we'll hold them in our warehouse until spring." He booked the sales. The revenue looked massive. The income statement said profit. The clown celebrates. But a smart analyst, a tycoon named Andrew Shore, looked at the numbers. He looked at the accounts receivable. He saw that while sales were going up, nobody was actually paying. The cash wasn't there. It was all fake. It was accounting art. Sunbeam went bankrupt. Chainsaw Al got fired. That is the revenue trap. If you are running your agency or your dropshipping biz or your SaaS tool based on the top line, You are driving a car with a painted-on windshield. You can't see the cliff coming. Part 2. Profit is an opinion. Cash is a fact. This brings us to the meat of the episode. If you take one thing away from today, let it be this. Profit is an opinion. Cash is a fact. I want you to tattoo that on your forehead so you see it every time you look in the mirror. In financial intelligence, they break down the income statement. This is the document the clowns love. It shows sales, expenses, and net profit. It looks scientific. It's nonsense. You can manipulate profit legally. You don't even have to break the law. You just have to change your assumptions. Let's talk about depreciation. This is where the financial artists paint their masterpieces. Let's say you buy a truck for your business. It costs $36,000. You pay cash. Boom. $36,000 gone. But on the income statement, you don't record that $36,000 expense all at once. No, that would make your profit look bad. Instead, the accountant asks, how long will this truck last? If you say 3 years, you record $12,000 of expense a year. If you say 6 years, you record $6,000 of expense a year. Did you catch that? Just by guessing that the truck will last longer, you just increased your profit by $6,000 a year. You didn't sell more. You didn't cut costs. You just changed an opinion. The book tells the story of waste management. They did this on a massive scale. They had thousands of garbage trucks. They decided to just extend the depreciation. They claimed the trucks would last longer. Suddenly, they are reporting hundreds of millions in extra profit. It was a mirage. They were cooking the books with estimates. Why does this matter to you, the agency owner? Because you need to understand that profitless prosperity is real. You can be profitable on paper and still run out of cash. Let's look at a scenario the book lays out, the Sweet Dreams Bakery example. Imagine a startup. Sales are doubling every month. They are profitable. The income statement says they are making money. But they have to buy ingredients now. They have to pay employees now. But their customers, the big grocery stores, don't pay them for 60 days. So, January comes. They sell $20,000, collect zero, pay expenses. Cash goes down. February comes. Sales hit $30,000. Amazing. But they still haven't collected January. They have to buy more ingredients. Cash goes down further. By March, they are profitable on the P&L, and they are bankrupt at the bank. That is the valley of death. That is where the clowns die. They look at the P&L and say, we're rich. They buy the office chair. They hire the assistant. And then payroll hits, and the bank account is empty because the cash is tied up in receivables. Profit is an estimate. Cash is reality. You cannot manipulate the bank balance. It is either there or it isn't. Part 3. The balance sheet is the scoreboard. This brings me to the balance sheet. The income statement is for the IRS. The income statement is for the media. The balance sheet is for the owner. The balance sheet tells you what you own, assets, and what you owe, liabilities. And the difference is your equity. It is the only statement that takes a snapshot of your actual health at a specific moment in time. If you want to know if an entrepreneur is legit, look at their balance sheet. We need to talk about working capital. The book defines working capital as your current assets minus your current liabilities. Basically, it's the money you have tied up in the gears of the machine. Here is the rule of the operator. If you grow too fast, you consume cash. At my agency, NexYear, we do physical gifting. We send high-end boxes to prospects to get meetings. That means I have inventory. I have boxes. I have items inside the boxes. I have shipping costs. That is inventory. Inventory is cash that is frozen. It's cash sitting on a shelf in a warehouse. It's useless until I sell it. The clown loves to have a full warehouse. Look at all this product. We're ready to scale. The tycoon looks at a full warehouse and sees a pile of burning money. If you are carrying too much inventory, or if your clients owe you too much money, receivables, your working capital balloons. You need more and more cash just to keep the lights on. The book talks about Tyco, the conglomerate that bought 600 companies in 2 years. They were growing like crazy. But their working capital was a mess. They had goodwill bloat. They were acquiring companies, but the cash flow wasn't keeping up. They were building a house of cards. You need to treat your balance sheet like a scoreboard. Are your assets real? Is your cash growing? Or are you just piling up receivables, promises from people who haven't paid you yet? Part 4. DSO, the metric of the operator. Now we get technical. If you want to know if someone knows how to run a business, ask them their DSO, Days Sales Outstanding. This is the metric of the operator. It measures, on average, how many days it takes for you to actually collect cash after you make a sale. If your DSO is 60, it means you work for free for 2 months. You are the bank. You are lending your customers money at 0% interest. Who does that? Clowns do that. Clowns are scared to ask for money. They sign the contract and say, "Oh, just pay us whenever. Net 60 is fine. We just want the business." They are so desperate for the revenue validation that they sacrifice the cash reality. Tycoons get paid. The book mentions Andrew Shore again, the analyst who caught Sunbeam. How did he catch them? He saw the DSO spike. He saw that while sales were up, the time to collect those sales was going through the roof. That is a red flag. That means either your customers are broke or your product sucks and they don't want to pay. Or you are fake selling product, channel stuffing, just to hit a quota. You need to track this. If your DSO is creeping up, you are bleeding. You are leaking oxygen. The book also talks about the cash conversion cycle. This is the holy grail. It's basically, how long does inventory sit? DII, plus how long does it take to get paid? DSO, minus how long do you take to pay your own bills? DPO. If that number is high, you are in trouble. You are funding the whole operation out of your own pocket. If that number is negative, like Amazon or Dell, you are a god. You get paid by the customer before you have to pay your suppliers. You are using other people's money to grow. That is leverage. That is freedom. Part 5. The NexYear Protocol. So how do we apply this? I'm not just reading this book for fun. I'm reading it to build a fortress. At NexYear, we deal with atoms, not just bits. We have physical boxes. That means we burn cash. If I buy 1,000 premium boxes and 1,000 premium gifts, that cash is gone. It's sitting on the floor. If I sell a campaign to a client for $50,000 and I let them pay me net 30, which really means net 45 or 60 because corporate accounts payable departments are lazy, I am floating that entire operation. I am acting as a bank for a client who has more money than I do. That is stupid. That is incompetence. So here is the NexYear Protocol, based on the principles in this book. 1. We are shifting from net terms to upfront. I don't care if you're a Fortune 500 company. If you want us to execute a campaign, you pay for the inventory upfront. I am not financing your marketing department. The book explains that cash flow is a reality check. By demanding upfront payment, I improve my cash position immediately. I lower my risk. I lower my DSO to 0. 2. I am ignoring the P&L and watching the cash flow statement. The book says there are 3 types of cash flow: operating, investing, and financing. I only care about operating cash flow. Are we generating cash from the actual work we do? I don't care about EBITDA. The book calls EBITDA earnings before I tricked the dumb auditor. Okay, I paraphrase that, but they basically say Wall Street loves it because it ignores real costs like capital expenditures. I care about free cash flow. What is actually left over? That is the money I can use to buy freedom. That is the money I can use to golf, to invest, to take care of my crew. 3. I am looking for the bias. Every time my accountant sends me a report, I am looking for the estimates. Did we capitalize an expense that should have been written off? Are we optimistic about that bad debt? The book says financial intelligence is about understanding the art. I treat my financial statements like a negotiation. I challenge them. I want the most conservative, brutal truth possible. If the numbers look too good, I assume they are lying. Listen to me. The market is going to get harder. The easy money era of zero interest rates is gone. The clowns who lived on venture capital and fake revenue are going to wash out. You have a choice. You can be a spectator, looking at vanity metrics, high-fiving over a contract that hasn't paid out, and wondering why you're stressed about payroll every 2 weeks. Or you can be an operator. An operator understands that cash is king. An operator understands that profit is an estimate. An operator builds a cash fortress, not a revenue castle. Get the book, Financial Intelligence. Don't just put it on your shelf to look smart. Read it, highlight it, use it to interrogate your accountant. Stop looking at the scoreboard the crowd is watching. Look at the real scoreboard. Tell me what you collected. Tell me what you kept. Tell me what you own. Everything else is just noise. This is The Short Game. I'm Drew Meitner. Stay loyal, stay honest, handle your business.
Nossa, é só de fim de semana.